Good morning, everyone. Charles Goddard here. It's time for our weekly look-see at the S&P 500. We are looking at, when we get to the chart, it'll be as of March 3rd, 2023. First of all, a quick look at me. There's that handsome devil on the screen right now, designations, etc., and we move on to our chart. All right, this is the S&P as of Friday. Now, if you remember, and I'm just gonna grab myself a pen here. If you remember, we've been tracking the S&P now since this low over here as the trend has been building, and we like to trade with the trend. And our definition of a trend, as you are beginners, most of you, is quite simple. We have some moving averages. The green is a 55 exponential moving average, the blue is a 21 exponential moving average, and the red is an 8 period moving average exponential. Now, when the blue has crossed above the green, our simple definition is that we are now in an uptrend. That is our setup. Our trigger is when the price and or the red crosses above the 21. So you can see we had a setup and a purchase in here, and we had a new high over here. We had a low here, which was a healthy low, as I've described in a previous video. It didn't take up more than 60%, 62. Sorry, the acceptable window there is 50% to 62% of the rise. We weren't stopped out, and so consequently we still have a trade in place. And from that low, you can see our setup reoccurred right here, and we would have had another purchase there up just above resistance that's showing there. Resistance being this point here. And so now we've now got a new high, we've got another low. That low is not anchored yet. We need to see just a little more, a few more up candles for that low to be anchored. But it's quite possible that we would then enter another trade at this point, and we would bring if you are one of those people that have a position open now, we would bring our stop up to here. So let's just go over that again. If this move up continues up past this line, then we're in with another position. Our stop would go in under here, and any previous stop we might have would also be brought up here, so that we have the first position is risk-free. So we have two positions open, but we have only one position carrying any risk. That's what we're trying to achieve. We're trying to build positions and maintain risk on one position only. So in order to do that, obviously the stop that we put in at the most recent trade, assuming we get it, it's got to be above where we entered our first trade or previous trade. Now, the other thing that we were looking at, as I mentioned to you last week, is the RSI did not drop below 40, and we could therefore expect a bounce. It was still within the range of a bull phase. Unless it drops below 40, we're going to assume we're in a bull phase and act accordingly. Now, if you are an aggressive type, you could actually make a buy along that resistance line. So if you get a close mind you, not a cross above, if you get a close above this line, feel free to enter a trade there. But most of us should be waiting for a close above this line, this resistance level, before we enter our next trade. Stop going here. Okay, so that just about does it. We can expect probably more rise coming from the S&P this coming week. So we'll see how that goes based on the movement of the RSI bouncing off the 40, just or not making it down to the 40, which is just the way we like it. And we've got a couple of strong candles kicking off our move up. So we'll see how that goes. The book I have out is available on Amazon. All the details are there. If you've got any questions about what I've just gone through, please post them, and I will answer them. Like and share if you feel so inclined. And I thank you very much for your attention today, and we'll talk soon. Bye now.